Whether you're day trading or making long-term investment decisions, it's important to know what the markets are doing. Often, this is done with market indexes, but these values don't always give you the whole picture, and oftentimes they don't. That's why smart traders use market breadth indicators. In today's video, I will share the best market internal indicators that will reveal to you the overall market movements. It may sound complicated at first if you're not familiar with these indicators, but trust me, they are real game changers and will help you to make better decisions. Technical analysis has one major fault. Almost all indicators and patterns are based on what happened in the past, not what is forecasted to happen in the future. And as being a technical trader myself, I have to always remember this when placing my trades. But there are some indicators that actually are forward-looking, and these forward-looking indicators are known as market internals. If they are used correctly, they might be one of the best tools you can use to time the markets. Market internals are mathematical formulas that measure the number of advancing and declining stocks and their volume to calculate the participation in a stock index price movements. By evaluating how many stocks are increasing or decreasing in price and how much volume these stocks are trading, market internals help in confirming stock index price trends or can warn of future price reversals. Breadth indicators are primarily used for two reasons. For market sentiment, because such indicators can help determine if a market is more likely to rise or fall, and for trend strength, because the indicators can help determine the strength of a bullish or bearish trend. There are many different indicators that traders and investors can use in their analysis. Here are the most important ones that can help you to break down the market and what move it's about to make. First is the advanced decline line. This indicator, mostly used in the US stock market, can be calculated on both a daily and weekly basis and is the most basic and widely used indication of breadth in the major US stock exchanges. The construction of the advanced decline line is calculated by subtracting the number of stocks declining on any given day from the number advancing relative to the prior close. When more stocks are moving up than are moving down, the line is advancing. It has a positive slope and its direction is higher, and vice versa in a declining trend. These figures don't take into account stocks that weren't changed on the day or the week, but only those up or down from the prior close. The value of the AD line always begins from some fixed starting point, and this means that the initial value begins at zero. What is most relevant in the advanced decline figure is the slope of the line and not the absolute cumulative value. The advanced decline line is seldom used by itself. Instead, is plotted against its relevant index to confirm trends or for the likelihood of reversals. There are four interpretations of the concept. First, the advanced decline line and the index trending upwards. A situation where the advanced decline line and the index are both trending upwards is said to be bullish. The rise in the index is driven by the rise in the majority of stocks in the index. As such, investors tend to believe that the market will continue its uptrend in the near future. Second, the advanced decline line trending downwards and the index trending downwards. A situation where the advanced decline line and the index are both trending downwards is said to be bearish. The decline in the index is driven by the decline in the majority of stocks in the index. As such, investors tend to believe that the market will continue its downtrend in the near future. A situation where the advanced decline line is trending upwards, but the index is trending downwards, is said to be a bullish divergence. The decline in the index is driven by a decline in a minority of stocks in the index. Therefore, it indicates that sellers are losing their conviction. As such, investors tend to believe that the market will show a reversal and trend upwards in the near future. A situation where the advanced decline line is trending downwards, but the index is trending upwards, is said to be a bearish divergence. The increase in the index is driven by the increase in the minority of stocks in the index. Therefore, it indicates that buyers are losing their conviction. As such, investors tend to believe that the market will show a reversal and trend downwards in the near future. Second, we have the McClellan Oscillator. This oscillator will be applicable to equities markets that have a substantial number of individual stocks that trade actively. The McClellan Oscillator also provides an indication of the trend in market breadth and is presented in a familiar way as a smoother difference between the number of advancing and declining stocks on the New York Stock Exchange. Because of the nature of momentum, a strong bullish trend is followed by a large number of stocks going up. A weakening bull market is signaled by a smaller number of stocks making large advances in the price, as discussed already with the advanced decline line. Buy signals are given when the McClellan Oscillator falls into an oversold area, which is defined as -70 to -100, and then turns up. Sell signals are generated when the McClellan Oscillator rises into the overbought zone at +70 and +100, and then turns down. When the oscillator is above 100 and falls below -100, it's a sign of extremely overbought and oversold market. Such readings can be associated with powerful bull or bear market trends. The rule of thumb with such extreme readings is to assume that the existing trend has staying power for only another couple of weeks or somewhat longer. Like the MACD or the stochastic models, the McClellan Oscillator is best employed looking for upside and downside crossovers from within an overbought or oversold area. There are often crossovers, for example in the slow stochastic, that doesn't occur in either its oversold or overbought zone. In similar fashion, the signals that occur in the middle ranges of the McClellan Oscillator are best ignored, without compelling other evidence of a technical nature. Third indicator is the ARMS index, or the TRIN. The ARMS index brings in volume to its formula, so it's a hybrid indicator with price and volume. The ARMS index indicates whether volume is flowing into advancing or declining stocks. The index shows whether more of the total volume is advancing volume, or whether more of the total volume is declining volume for all stocks on that exchange. If more volume is associated with declining stocks on any given day, that day's ARMS index will wind up being above 1. If more volume is associated with advancing stocks than declining stocks, the ARMS index will register under 1 at the close. The ARMS index is calculated over the course of the trading day, but the close is primarily what is of interest. Extremes in the ARMS index have an inverse relationship to the market. High ARMS index readings, well above 1, indicate heavy selling pressure. If ARMS index closes above 1 persists over a few or more days, this is associated with the likelihood that the market is oversold, perhaps near a bottom, and might soon turn up. In this sense, the ARMS index functions as a contrary indicator. The idea is, if everyone is selling, it might be the time to buy. It depends of course on the circumstances, but when either buying or selling activity predominates, it gets overdone, hence the terms overbought and oversold. Traders generally take anything under 1 to be a buy signal. Conversely, a number above 1 is a sell signal. The further away you get from neutrality, the stronger the bulls or bears are on that day. However, if trend gets too far away from 1, it's a sign that the market may soon reverse. A number above 3 or below 0.5 could be a sign of an imminent reversal. Traders use market breadth indicators in conjunction with other forms of technical analysis, such as chart patterns and technical indicators, to maximize the odds of success. For example, if the advanced decline line starts to drop while the S&P 500 is still rising, traders will watch closely for the S&P 500 to break below a rising trend line or a break below support, or for technical indicators to turn bearish. This may help confirm that the price may starting to decline, and therefore the trader can exit longs or initiate short positions. If the majority of the securities tracked by the indicator are advancers, then investors expect a rosier market going forward, while a majority of decliners would give investors pause, indicating weakening demand for the stocks. Essentially, market internals point to a convergence or divergence in securities markets. If the data reveals a confirmation, then the market index being tracked will continue its direction. If there's a divergence, then the market may steer into a different direction. Market internals can provide a much needed clarity for investors and lead to more stable and savvy investment outcomes. So by determining whether more cash is flowing in or out of the market, breadth indicators can be a reliable, powerful predictive tool on market movement and momentum, one that can give investors a big edge over the competition on a regular basis. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel, and click the bell icon to stay notified when we upload new videos. Until next time.